Hello and welcome everyone. Thanks for joining us today. I'd like to start by acknowledging the traditional custodians of the land upon which this university is situated, the Wadamadigal people of the Darug Nation, and pay our respects to the Darug people and the Wadamadigal clan, and to our Aboriginal and Torres Strait Islander peoples who are joining us today. We will be using the Q&A function for this session today, so if you have any questions for our presenter or our alumni, please direct your questions there. The Q&A button is pretty prominently on the taskbar below this Zoom call. So firstly, let me just introduce myself. I'm Lindesay Brine. I'm the Director of the Applied Finance courses postgraduate, and the Master of Applied Finance is a degree that I am looking after on behalf of the university and on behalf of all the alumni as well. And I look forward to hearing more from Dan with a taster of some of the things that are really prominent in industry today. And one of the things I would like to emphasize is that we bring together a bunch of people who are generally from industry, like they work in finance, they might come out from outside of finance and want to get into it more, or they might be people wanting to take their degree to the next level. And through sessions like this masterclass, also through referrals from existing alumni and from direct recruitment, we get people in to do our degrees. Now, while people are doing those degrees, they learn about the most recent developments in finance, and we're working hard to make sure that we have those available for you. But equally, we put on seminars like this that everyone is welcome to. There's alumni networking where we actually have students and alumni get together. There's LinkedIn groups, and then we have a session called the Finance Professionals Series, which is designed to bring prominent industry topics to a wider audience, including our students, alumni, and people in finance who are interested in those topics. And we have one coming up in December, which you can hear about a little bit later, and we're happy to talk to you about. But then once people finish the degree, their engagement with Macquarie Uni is not ended. We do have continuing professional development, and we provide exec ed and tailored training to particular corporates. There are further seminars, and there are alumni seminars and networking events which are put on to help people. And then there's the LinkedIn groups that continue. So wherever you are in your journey, there is a stage where you can get involved with the university and you can maintain that connection. And we look forward to welcoming new students in term 2 of 2021. And with that in mind, we are very pleased that we actually achieved a top 50 grade from top universities for the Master of Applied Finance. We are actually #1 in Australia, and we're equal #1 in the Asian region, and we want to maintain that. So we are continually developing our course offering and the unit offerings to make sure that we're keeping up with what is required for finance today. And the topics that Dan will talk about today are really important for applied finance for both now and in the future. And some of those materials will be reflected in the units that we offer next year. So let me now introduce Dan to you. Dan is actually the Deputy Head of Applied Finance at Macquarie University. He has been a lecturer for many years on the Master of Applied Finance, and he has recently been awarded his PhD. So we welcome Dan. So Dan, I'll hand over to you.
Thank you very much, Lindesay. I'm sorry that I'm not more handsome than the previous photo that you've seen there. While I was listening to Lindesay, I did recall some recent talks that we were running at lunchtimes, particularly face-to-face at the beginning of this year before COVID, and then we've run some seminars as we're doing now as webinars or as group talks. And there's been quite a few that have overlapped this area. So one on the landscape of ESG ratings, environmental, social and governance ratings, one on carbon neutral funds, others to do with sustainability and getting the head of sustainability from Fidelity to come and present to us. And why I thought of that was the emphasis that Lindesay has made on the connections between finance, particularly the deep dive you make as you do the Masters of Applied Finance and the associated qualifications, and the relevant areas of impact, not just in the finance industry, but on the community and, as today we'll see, on the environment more broadly. And that's one of the benefits of having the Applied Finance Centre located alongside particular dedicated focused research groups, some on fintech, obviously mine to do with sustainability and ESG investing. And so I'll comment more on that at the end of this talk, particularly where I see the impact for us as we come out of the applied finance programs and we fill different jobs, particularly at the moment with the ESG teams growing domestically and internationally at the institutional investment firms, investment banks, and the funds management firms. So I'll share my screen with you, and you can see that our talk today is on the Sustainable Development Goals, ESG ratings, and particularly the rating agencies, and they draw heavily upon corporate reporting. And so I'll particularly be looking at some of the reporting paradigms and link those to planetary boundaries. And the underlying theme here today is that there's a commonly held perception that there's just too many frameworks, and that the frameworks overlap each other, or worse, they conflict with each other. And I'd like to encourage us to have a slightly different perspective on the different frames today. And therefore, I'll commence with talking about frames that aren't explicitly finance, and then build to those, especially the corporate reporting frames. And the idea is to appreciate that some of the frames are about the end game, the objectives, where we are heading or where we wish to head. And then if we have that perspective in mind and we look at some of the corporate reporting frameworks that the ESG rating agencies draw upon, we're going to see whether there needs to be more alignment, what things are missing, to what extent we might need more than just the information coming from the corporations, and in particular the information from ESG rating agencies. And then that raises additional questions. Many investment firms use multiple ESG rating inputs to their process, and so thinking through the question of how many do you actually need to achieve the end goal? So that's where we're heading, and therefore we'll start with something that feels distinctly non-finance, but all the way through I want to emphasize that it's all about the corporations. And the research I've been doing, as Lindesay kindly announced, I have completed a PhD in social responsible investing, but extending to environmental, social and governance events. And in the other centre that I'm part of, the Centre for Corporate Sustainability and Environmental Finance, the sort of research we do there is primarily focused on corporations. And that's for two reasons. Essentially because of the impact now and in the past the corporations have had on society and on the environment, but also the extensive resources available to corporations to therefore potentially achieve significant outcomes, achieve sustainable development outcomes, and as you'll see, potentially protect some of the barriers associated with our Earth systems. But the point to be made will be there needs to be alignment, and in order to have the right reporting tools over which we might use to implement management and strategy and test that we're actually doing those things to then look at outcomes and impact, the research that we're doing here seeks to point to the deficiencies that need to be built into corporate responsible reporting. So the first framework that we're going to look at was made famous by Rockstrom in 2009. Rockstrom and a team of scientists from the Stockholm University, that established the 9 barriers that we'd need to be mindful of before we jeopardize the future survival of this planet. And so they emphasized the conditions of our planet that would provide the supportive environment for maintenance of life as well as human development. And they therefore use that definition of the Earth system to identify subsystems that they described as planetary systems, and then identified barriers beyond which, if we impede, if we go over those barriers, we put at jeopardy the long-run stability of our planet. And as I look at the diagram, you can see there on the planetary boundaries, some of the subsystems are quite familiar to us, of course, climate change, and our hero Greta Thunberg has made climate change top of the pops in terms of our understanding of the important systems in the Earth that we live on. As we look across in the planetary boundaries, you can see something very familiar with Australians over the last three decades, in fact, and that is the ozone hole and the depletion that led to the ozone hole. Others familiar with Aussies would include ocean acidification and the availability of fresh water. But there's others there that are perhaps less familiar to us. And so eventually when we're talking about exciting impact that finance professionals can make to this space, and we'll think into things we've covered off before, such as the carbon neutral investing, you'll see that the themes we encounter here could in fact be themes that inform financial instruments, bonds related to achieving particular goals around these themes, and what I mean in terms of balancing portfolios towards achieving more broader societal and environmental outcomes. And therefore, I'll just point to perhaps the novel entities area not being a commonly known area, although it does speak to waste. So typically the 3 main threads there are plastics, especially at the micro broken down level, radioactive waste, and of course genetic modification of entities. And so looking at that area there, you can see that's quite a rich array of things that can undermine systems across our planet. And the original purpose of not just Rockstrom, but in 2015, Stefan et al., including Rockstrom and other scientists, revisited the paradigm to start to fill in some of the spaces and add more indicators. And they pointed to, there's 4 boundaries that we've put in jeopardy. We've either passed the important boundary levels or have approached those levels. And the 4 include climate change with carbon emissions, as well as the heat generation associated with greenhouse effect. Our substantial dependence upon fertilizers contributing to significant nitrogen and phosphorus flows beyond what we've experienced prior to the Industrial Revolution, and therefore in environments that humankind didn't have significant impact on the environment. And we're way over those levels now, and therefore unlikely that the environment can just easily absorb those flows. The others are particularly pertinent. One is land system change, which has overlap effect on many of the others, and in particular on diversity. And so deforestation has significantly pushed us to the barrier on land system change, and therefore related to that is the impact on biodiversity, which is under that biosphere integrity part of the curve. And if you watch any of David Attenborough's productions, you can appreciate the extent to which the extinction rate on the planet is far higher, is arguably 10 to 100 times higher than the normal or acceptable extinction rate of species in the past. And so I'd have to apologize. That's a pretty dark and gloomy part to this short talk on ESG and Sustainable Development Goals to start with. And a spoiler alert, I'm not sure I reverse it and make it positive by the end of this coverage, although I do point to distinct glimmers of hope and the potential optimism we have, especially with the combined role of corporate reporting and others that report on corporations. And again, I'm particularly thinking of ESG rating agencies. So let's move through another boundary and I'll make sense of where this particular framework fits with the eventual corporate sustainability frames. And the second frame is perhaps far more well known. That is the United Nations efforts to create the Sustainable Development Goals. And they've done an incredible job of saliently combining and communicating a vast array of the most important or pertinent issues that the world needs to face. And as you look at the typical image they have of the 17 SDGs, you might be forgiven in thinking that they cover off enough of environmental issues. And I'll be making the point that we actually need those planetary boundaries alongside the Sustainable Development Goals in order to have a comprehensive target to then evaluate and think into responsible investing frameworks. And I can see some environmental squares or blocks. I could see the 13 climate action, 14 life below water, 15 life on land going on there. And in a similar way, I can see the other 3 pillars, quite a traditional framework of thinking into the main dimensions of human existence and human activity and its impact on the environment. And the 3 include ecology, include economy, and include society. And I can sort of make out that there's some economic activity going on, particularly 7 with energy, 8 with economic growth, and 9 with industry and innovation. And then finally with social, you could see across the top there, tackling poverty, zero hunger, health and well-being. Now, there is a significant weakness to see the SDGs that way. And the weakness is that that framework of the 3 pillars emphasizes a silo attitude to each of those dimensions. And the problem with that is that some initiatives to achieve some of those dimensions might actually potentially undermine the achievement of the other dimensions. And as we think through the interplay of those dimensions, I'm sure you can appreciate that as a country increases its economic prosperity, it's more than likely able to supply greater social benefits. There's even more complex connections, though. I had the opportunity to review a paper recently looking at the Kuznets curve, linking pollution in the form of particles in the air with economic activity, and the distinctly non-linear relationship between the two, that with early stages of economic development across countries, there's significant pollution, particularly air particles. And later on, though, for many countries, there's a subsequent control and even removal in some cases of some of the most important air pollution particles. And so my point is, not only are those 3 areas, the environment, the economic activity, the social concerns, interrelated in complex ways, but even the way in which one affects the other can be non-linear, can be quite complex to model and manage. And therefore, as you look at the SDGs, you need to appreciate that it is actually quite a sophisticated set of goals that reflect the dynamics, the interrelationship between many of the features of society, economy, and the environment. And that's most clearly observed if you look at the targets that underpin, the SDGs. And you'll find that, for example, the environmental issues are peppered across a great number of the targets within the SDGs. So that's the good news with the SDGs, that it is a negotiated agreements across countries in order to achieve particular sophisticatedly thought through reflections of what affects our society, what affects our environment. Here's the bad news. The bad news is it significantly lacks any teeth in being operational. And the lack of teeth is attributed to two things. If you do read an author, Elder, in 2019, he and his co-author were able to just document the development to achieve the SDGs and what the negotiation looked like between the countries. And they point to a significant amount of diplomacy and deal making that occurred, and the possibility that some countries really needed to downplay some of the environmental and social concerns over the need for continued significant progress on the economy. Further than that, he points to the end of the agreements of the SDGs and the targets then being followed essentially by a different team, a team of technicians coming in to identify a very thankless task, to identify existing indicators that we might use to then set levels and quantification of those targets and the SDGs. And that's where Elder argues that there's a significant lack of being able to operationalize the SDGs. And in particular, that author, Elder 2019, points to the problems in terms of reflecting the environmental concerns that faces the world. You can therefore see that I'm making the argument that if we're going to set some of the frames to represent the goalposts, we'd actually have to combine key elements of the planetary boundaries alongside the SDGs, the Sustainable Development Goals, in order to have a comprehensive reflection of the societal and environmental concerns and have the ability to essentially drill down to metrics and devices that we not only monitor, but might be able to do some strategic management in order to achieve. And so it's with that in mind that we turn our eye to the corporate reporting frameworks. And I've got a slide that tries to capture a sample of those paradigms. And you can see there that I've got the SASB, the Sustainability Accounting Standards Board, who do a fantastic job of looking at the granular elements of business themes and identifying the most important sustainability reporting required, the sustainability issues for each of the business types or industries. And then above the SASB icon, I've got the GRI, the Global Reporting Initiative, and that will be the initiative that I speak to in a moment in terms of thinking back to the goalposts. And there's reportedly more than 15,000 organizations that are actually adopting the GRI standards and indicators. And then we've got the integrated reporting that's been with us for quite a while now, with the emphasis on a broader set of important stakeholders, the CDP with the Global Environment Disclosure System, and the TCFD with its climate-related disclosure, just recently been promoted to be mandated in New Zealand. Not yet, but to be brought in for all companies in New Zealand. You can see my image in the middle there. I couldn't help but think of an article in The Guardian about the burden that all the reporting frameworks potentially represent. And it echoes a discussion I had a little while ago with a student from the program who is now a resource analyst and looking at the value of different mining companies. And he similarly heard that my research in my PhD has been on environmental, social, and governance concerns. And his response was, Dan, ESG sounds like a lot of form filling. And it's that sort of attitude, unfortunately, that we're going to have to address. And we won't address it today, but you can see that that will be one of the launch bits at the end of my talk here, as we think into how to motivate and engage key participants and organizations to actually not just be reporting and coping with that burden, hopefully in an efficient way, which will be my point in a moment, but building upon that reporting and being able to do something and be able to manage exposures and impact on, for example, planetary boundaries. So as I look at the GRI, the Global Reporting Initiative, with its many very specified standards and indicators, I've brought it into analysis, or Lulu Wijawati and my other co-author, Martina Lenin-Luca, have actually brought them in together. You can see substantial overlap, that there's a big shaded area in which the Global Reporting Initiative's indicators on the left overlap both the SDGs and the planetary boundaries. But if we leave the analysis at that stage, and that is to just draw upon the direct definitional connections between the standards and what's going on in the SDGs and the descriptions in the planetary boundaries, Earth systems, and the control variables there, I think you'd have to agree with me, there's still substantial mismatch, there's substantial gaps. And fortunately, our analysis has done that extension that we find in ESG ratings by ESG rating agencies, and that is to think into those themes associated with the global reporting indicators and tie those themes to their impact on the planet, their impact on society. And if you do that, the gaps become much less. And so you can see that I'm pointing to, there's a potential role that is covered off at the moment by ESG ratings, and that role can be supplemented, supported through further drawing together the GRIs and the ESG ratings towards covering off the missing things, or the things not totally and sufficiently covered off in relation to the SDGs and the planetary boundaries. So you might be thinking, what are the ESG rating agencies that I'm referring to? And I just put together this slide here. These are the 4 that we're focused on with our current research, and looking into the benefits and merits of the different ESG rating paradigms in light of the end objectives, but also the improvements that can be made to them. And so you can see Sustainalytics, MSCI's ESG ratings. They have a broad range of ratings, and similarly, Bloomberg has a broad range of tools, but specifically the ESG set of tools that Bloomberg offer, and Refinitiv with their analysis leading to their ESG score. And you could imagine the challenge and the problem looks very much like a puzzle, and you've got these grids to fill off. And as you look at a major reporting paradigm or frame, as I chose GRI, you can see that as you overlay that over the puzzle, you can still see some grids not covered off. And the ESG rating agencies, at least for the role of the investment managers, sort of come riding to the rescue and add another layer. And so the gaps diminish somewhat. And so our analysis is pointing to not just how many more ESG rating agencies you should have in addition to the reporting you can get directly through your shareholdings or the broader reporting by the companies, but which combinations of ESG rating agencies are the best to hold together to actually efficiently achieve the coverage of societal and of environmental concerns. And so I'm hoping I'm not running too far ahead of time, but I want to conclude with some observations. I'm just saying that I think I'm running ahead of time because I've failed to turn on my clock. So if you do notice a lecturer in any one of your classes that fails to turn on their clock, be ready to point out to them that there's a coffee break coming up, and that we usually have coffee breaks as students in order to cope and survive into the next material. So just a tip for future. In conclusion, just a couple of things. You could see that what I've been chatting through and talking through here is merely one element of a much bigger picture. And so the element I'm focusing on is that the ESG ratings that we get and the reporting from the companies, how they might successfully or fail to successfully give us what we want in terms of this broader set of stakeholders, and the stakeholders including planetary as well as the societal affected individuals and groups and communities. You could see that there is a bigger picture, and the bigger picture, I think, is quite clearly illustrated this morning with the launch of the Australian Sustainable Finance Roadmap. And so that's worth having a look at as an example of the many facets that need to be covered off before there is significant acceptance and engagement with achieving sustainable outcomes. But thinking about that itself is part overlaps research that we're doing with respect to the need to motivate engagement. And that research has been putting together the impact of investor action and the need for investors, particularly institutional investors, to combine with other key stakeholders and key parties, including regulators, to have the best bang for their buck in terms of getting corporate change. Secondly, the need and role for incentives, for example, executive compensation, and how it might be tied to particular outcomes, either ESG outcomes or more broader planetary outcomes, for example. And where there is not a business case, you can appreciate that those incentives could line up not just with achieving environmental, social, and governance outcomes, can line up with achieving profitability and business outcomes. But where there is not direct business cases, either assisting the monetizing of the supplementary benefits to society and pitching that to government, or alternatively, of course, at the end of the road, bringing in regulation to do what otherwise business and companies and investors are not achieving. And now the other thing thought I'd like to conclude on is, of course, how exciting this area is for finance professionals. And we have this unique opportunity of bringing our skill set, a skill set that is not very readily available to many of the stakeholders that are affected, but a skill set that can actually produce those financial instruments that, as I implied before, might include hedging style layoffs of risk and exposure, such as carbon neutral equity portfolios or carbon neutral bond structures, but then extending beyond carbon to the many sustainability issues, society issues, and environmental issues that our structures, our financial instruments might address. Alongside that, of course, you can appreciate the need for balanced portfolios. And I don't mean in the sense of diversification. And I do appreciate that climate change is, again, top of the pops in terms of a very important element of planetary systems, planetary boundaries, but you can appreciate there's many others as well. And therefore the need to be investing exposures that complement and drive good outcomes across all of those planetary boundaries, as well as the societal concerns. Well, that's all I wish to bring to you today. An academic fails if they don't draw attention to an article of theirs, though. So I've put up a simple QR block that I'm hoping you've got an image of by now. Otherwise, send me an email. And as I hand over to Lindesay, feel free to send emails to me after our discussion. If you don't get a chance to raise a Q&A question in this session, and I'll respond to you directly. So I'll stop sharing if that's okay, Lindesay.
Thank you, Dan. And yes, that did work. I actually got to use that myself. So well done. Okay, I'll just share my screen now, and hopefully we can see a slideshow. Is that right? That's it. Okay. It's now my pleasure to introduce our alumni for today's session, who is Simon Schwarz. Now, as it says there, Simon is currently Chief Financial Officer and Company Secretary of BizCover, and he did complete his Master of Applied Finance in 2003, but he has had a steady involvement with the Applied Finance course, having been involved in a rewriting effort in the Financial Risk Management course in 2015, and has served on that advisory panel. Since finishing up in investment banking, Simon has had quite a career in fintechs and startups, and I think it will be interesting for the people on this call to hear how the Master of Applied Finance has helped Simon to develop his career. So Simon, I'll hand over to you and I'll stop sharing.
Thanks, Lindesay, for the introduction. As you said, I graduated my Master of Applied Finance from the Applied Finance Centre in 2003 as I began my career. I was attracted by the balance of theory and applied practice taught by academics who are also practitioners. I attended many finance professional seminars over the years. As you mentioned, I joined the MAFC as an honorary fellow in 2015 as co-author of the credit risk section of the Financial Risk Management course. I lectured that course. And I've been the keynote speaker at several MAFC prize days, talking about my experiences in peer-to-peer lending. When I left traditional banking in 2015, I joined Society One as the Chief Operating Officer. At the time, Society One was Australia's largest peer-to-peer lending platform. My background to that point through my career in banking was really traditional banking and risk, structured finance, project finance, asset finance, and then credit risk, market risk, enterprise risk. I learned all of those disciplines both through on-the-job training and experience, as well as my MA Fin studies right at the beginning of my career, which I would say provided me with all of the fundamentals I needed to succeed at the time, both in my traditional banking career, but also in the world that hadn't been invented yet. You know, when I commenced my MA Fin studies and my banking career, the word fintech wasn't even in the dictionary, let alone taught in traditional applied finance studies. And when I entered the world of fintech at Society One in 2015, I wasn't quite sure what to expect. The world I entered was one of new world concepts: digital marketing, software and web development, SEO and SEM, lean startup, build, test, learn cycles, minimum viable products to get to a product market fit as quickly as possible, user experience, customer experience, to try and deliver brilliant net promoter scores, and then project management to try and develop as quickly and robustly as possible in the technology sphere. So I learned agile product development as well. What I found very quickly, though, was that Society One, and in fact all fintech businesses, are really underpinned by traditional banking concepts: credit risk, liquidity risk, balance sheet management, operational risk, governance, capital, regulation risk. And those fintech businesses that hadn't learned or didn't understand those traditional banking concepts very quickly got into trouble. It's all very well in a general technology company to experiment, to fail, to try again, where really what you're looking for is a product market fit. But operating in a regulated financial environment where regulation and in fact the ability to continue operating either because you've fallen foul of, or you've complied with regulation, or insufficient capital, or liquidity risk, or poor balance sheet management. All of these things can blow up a fintech business. And we saw that the early iterations of peer-to-peer platforms did exactly that. The first peer-to-peer platforms, I call them, 1.0, was simply eBays of the lending world. That's how they were conceived, where borrowers would bid for lenders to provide them with capital, but the lenders didn't really have enough information to properly credit assess their borrowers. And what was very quickly found was that the returns delivered to those lenders on those early peer-to-peer lending platforms were negative, materially negative, primarily because they lacked insufficient information to undertake a robust credit analysis on their borrowers. So what started as essentially eBay model of buyer beware type platform very quickly iterated into peer-to-peer lending platforms, where the credit risk management and the liquidity management of availability of lending funds on the platform was undertaken by the platform itself. So even though the lenders were the ones that provided the capital and the liquidity and took credit risk on the borrowers, the credit risk function, the liquidity risk function, the balance sheet management function very quickly began to be undertaken by the peer-to-peer lending platforms as well. So what I learnt through this experience, and indeed in all of the fintech businesses that I've been involved in since that time, is that these traditional banking concepts, credit risk, liquidity risk, capital, governance, operational risk, etc., which are taught in the MAP Fin course by the Macquarie Applied Finance Centre and applied in real world banking and finance, are also the underpinnings of all of these new world fintech businesses. So I would say to you, all of whom I understand looking to get into finance or in finance, looking to upskill yourself in traditional banking studies, my message is innovate. By all means, go out and innovate, but only with awareness and respect for the fundamentals of banking and finance. What I've found through my experience and studies is that the Macquarie Applied Finance Centre will give you the fundamentals, as well as an appreciation for the cutting edge. And that's what's enabled me to leave my traditional banking career and move forward quite confidently and successfully in the various fintech and startup businesses that I've been involved in since that time. Thank you.
Thanks very much, Simon. And as I have said a couple of times on the chat, please keep those questions coming. We have a good few questions. So Dan and Simon, if you wouldn't mind just staying with us for a second, there's a couple here, I think, which might be very pertinent to all of you. Dan, the first one is from Tenchel Morrison. You've been promoted to professor. How do you envision the key determinants of ESG ratings will change in the upcoming years?
Thank you very much, Tenchel, for the promotion. I'll pass that on to the executive dean later on. Look, I think the progression of ESG ratings is actually going to be in line of continuing developments of the SDGs. And there's two ways in which I think ESG ratings are going to evolve in the next little while. And one of those will be, as I said, the planetary boundaries are somewhat missing in the SDGs, and we're using the SDGs as the standard to evaluate good or bad ESGs. I mean, not just we, I mean, the entire industry. And therefore, as we get real with the science of ecological impact and introduce more robust indicators and the metrics around those indicators, they're likely to be copied or absorbed into ESG ratings as well as the SDGs. And the other thing I think we'll see is greater saliency. And by that, I mean just turning the complex into the easy to comprehend. And the SDGs achieve that, and that's why they became so popular. My university, many institutions display the SDGs that they achieve through their activities. In a similar way, just to pick one example, Morningstar's ESG rating firm, Sustainalytics. Morningstar recently purchased Sustainalytics. The combination of those two have achieved a very easy to interpret ESG rating for funds. And they did that on the basis of something very complex, and that is the ESG ratings for individual companies, but transformed it into something that looks and can be investigated in a very easy manner. And so what I think we're going to find with the ESG ratings is more investment in, yes, continuing to map these very complex interrelated systems, but presenting them in a way in which it's easy to communicate to your clients, your industry funds, if I'm thinking of investment managers. So, Lindesay, did you want me to offer anything in regard to Harry's question as well?
I'll come to that.
Yep.
I was actually going to answer one myself and then ask Simon a question if I could.
Yeah,
there was a question from Anthony, and he's talking about the requirements for the course, and work experience is probably the biggest thing that we need for this course, for the units, for the degree. You must have some work experience. Now, if you don't have a finance degree, we can solve that. If you don't have a degree, we can also solve that. The way we do it is through our foundation units, which provide that foundation. And in the case of the graduate certificate of finance, that would actually give you the equivalent of a bachelor's degree. So for people who have work experience, but don't actually, who have professional work experience, but don't actually have a degree or a finance degree, then there are ways we can incorporate that. So the avenues are all there. So Anthony, happy to talk to you about that. There's definitely a way to get into the Master of Applied Finance, even if you don't have a degree. Okay, so Simon, I had a question for you. Pauline has asked, they're curious about what you've learned in finance back in the old days and what has changed most significantly in recent years, and what you've seen in your daily job, that what sort of changes are coming in the finance industry, especially in Australia. What do you think about that one?
So I'd say with a focus on credit risk, the largest change that I've seen come in a big way already in Australia is the application of machine learning and artificial intelligence to credit risk assessment and management. It used to be that all of the models that were built were really closed form analytical models where human practitioners needed to understand the basis for the model and how the model would calculate the credit risk of a given portfolio. What has happened now is that machine learning techniques have become so advanced that if you look at the analogy of AlphaZero in chess, once humans had taught it the rules of chess, it then taught itself how to play chess better than any grandmaster, in any human programmed computer in a matter of days by playing against itself 1 billion times. And similarly in credit risk, we have models that now teach themselves and are better able to assess and manage credit risk, than any human programmed model. And I think that's the big change that we're seeing right now, but both in retail credit portfolios, but also even in wholesale institutional portfolios.
And Simon, would it be fair to say that if you go back to when you were doing your Master of Applied Finance, I was doing mine, we focused a lot on models and heuristics and rules of thumb. Whereas, as you pointed out with credit, you're now modeling every possible outcome. And there's a lot more modeling of potential outcomes rather than just using a rule of thumb. Would that be fair?
That's right. I think we both now have the computing power as well as the techniques available where heuristics are used where they give a convenient solution to a problem that is difficult to solve. Now we both have the computing power to solve many of those problems, and we also have machine learning, artificial intelligence techniques that allow you to solve the problem without knowing particularly how the machine got to the solution. solution. But the machine learning techniques have advanced to such a point where, as long as you give the computer enough context about the environment and the portfolio, it will work out the solution itself, even if it can't explain to you how it got to that solution, but you can verify that it is the best solution.
Thank you very much for that, Simon. And Dan, one for perhaps you and I, Harry Agnew's question about your research across ESG and SDGs. They're particularly interested in that. Which subjects in the Master of Applied Finance is there a focus on responsible investing?
Well, trying to sell my own units, it'd have to be anything to do with buy side and investment management. Clearly, Lindsay's aware that there's this continual competition that goes on between lecturers on the program that wants everyone to come and do their particular units. The reality is right across the program. I had the great opportunity of visiting Oxford when we could still travel at the end of last year, and was interviewed by a researcher there who was doing a survey of the entire globe of how universities were incorporating teaching about sustainability into their programs. And so I was able to share how you find particular case studies, irrespective of the unit, that actually draw in the environmental, social and governance concerns. I did have the opportunity to support a unit recently that included a resource case study. And within that case study, of course, was the ESG risks that the management of the company had to address and face. So it occurs all the way through the program, but you will find sort of hotspots in terms of depth of analysing the frameworks and rigour in critiquing those frameworks. And one example would, of course, be the ESG related portfolio construction, how to do that and how to incorporate sustainability into your portfolios. But I'll hand back to you as well, Lindsay.
Sure, because I think that's the point, is that it crosses boundaries. And even when we say, obviously ESG portfolio construction will be a very big part of it, and there's a unit, advanced investment management, that will cover things like that. But then equally, when you're looking at something like sustainable finance, which is another unit, well, there's two sides to sustainable finance. So a green bond has a buyer as well as a seller, as does a sustainable bond. So it's important to understand what investors are looking for and also what borrowers are looking at when they're doing sustainable finance. And so that's what the unit will cover. And that will be offered later in 2021. So there's an opportunity to cover both sides of it, and even to incorporate things like sustainable deposits, which are a thing and are happening now. So, all these things are new and they're starting off quite clearly, and we want to make sure that they are incorporated into the unit. A couple of questions from me, just so I can clarify. In 2021, the course starts in term 2 of 2021. The cutoff for applications will be in February, and I'm happy to speak to anyone that wants to talk about the course in more detail. And I'll pop up a slide shortly with a link for that. And we'll also make sure that that's available in any follow-ups. So I've answered that one. And then the classroom sessions. Yes, really good question, Cameron. Thanks for that. One of the things that we discovered this year is that you can pivot from face-to-face to online reasonably successfully in a very short period of time. However, you do miss that networking. And so the aim for the classroom sessions in 2021 is to ensure that there is a face-to-face option for people who want to be in the room, but equally we want to make sure that there is an online option for people who can't or aren't happy to be in the room. So we call that hybrid. It'll be both online and face-to-face. So I think that one will help everyone. We're also making sure that the units actually take place in the evening, and that and they're all online. Any face-to-face, any face-to-face sessions will be on weekends, and each unit will have up to 2 weekends of face-to-face and combined online. Now, a final question for Dan, actually, from Anthony. Do you believe sustainability will be incorporated into asset valuation, or more importantly, should it be included?
Thank you, Anthony. Of course, it's all gamification. There's always a game going on, and having more questions about sustainability means that we're on the winning team. So thank you for that. It's a difficult question, though, Anthony. To some extent, arguably, ESG-related issues have always been part of valuation, and we might be merely renaming some of the issues and concerns in this paradigm of language and frameworks. I have had the opportunity to supervise students recently writing Harvard-style case studies, and one of them was interviewing an alumnus, ex-student from the program, who was an ESG, head of ESG for a significant, a large asset consulting firm. And in asking that asset consultant, who's responsible for ESG? Is it the universal asset owner? Is it the asset consultant? Is it the investment manager? Her response was, I don't know when ESG got separated from all the important risks. And I think the same attitude applies to valuation, although I think there are, especially with the use of insightful, clever finance technology, a new focus on some of the ESG and sustainability related dimensions that do actually provide more credible, defendable valuations in particular. And two examples I've seen of this recently is in regard to stranded assets, where contingent claim methods have been used in comparison to other discount cash flow, for example, methods used in regard to specified exposures to stranded assets. And related to that has been renewable energies, the estimation of new business opportunities that aren't certain, especially if we have governments that change and then change again their attitudes and policies about, for example, renewables. It becomes a contingency, and therefore the appropriate methodology comes from us, option pricing methodologies. So I think we're going to see more ESG incorporated in valuation, but the more is going to be more sophisticated recognition of them.
Thank you, Dan. And look, I will just quickly share this screen one more time. We did get one more question. Thanks, Hamid. The next session that we are hosting will actually be on Tuesday, the 8th of December. It'll be on a slightly different topic. It's about board diversity. Should be an interesting read, and I will be putting that out very shortly on LinkedIn and other channels. If you would like to hear more, please contact the team here. If you'd like to know more about the course and you'd like to hear from me or speak to me about studying the Master of Applied Finance, please note that link down. Equally, we'll make sure that link is available to you. And we're happy to have a personal consult with you and to conduct that over Zoom, or I can do that personally in the city. Okay, so I'd like to thank everyone for coming along today. Special thanks to Simon for sharing his journey and the move from traditional finance to fintech. Thanks to Dan for sharing his experience of ESG and the sustainable development goals. And thanks to the team for putting this on. Thank to you all for joining us, and thank you very much. We'll leave it there. Thank you.